The dollars were gold, and they were payable to the bearer on demand. And so in 1971, when Nixon told our note holders, we're not going to pay you anything for your notes. Yes, you may have 35 Federal Reserve notes, but you can't get a dollar for it. You can't get anything. All you'll get is 35 ones. Right? If you have a 20, a 10, and a 5, we're not going to give you an ounce of gold, but we'll give you a bunch of ones, but you're not going to get any real money. You're not going to get any actual dollars for your Federal Reserve notes. That was a default. And it wasn't even a partial default. We didn't tell our creditors, we're going to give you half as much gold as we promised. We told our creditors, you're not getting any gold. You're getting nothing. It is a 100% default. That's what we did.
In 1971, the United States made a decision that permanently changed the monetary system. The dollar would no longer be convertible into gold at the official rate. More than 5 decades later, Peter Schiff argues that America is approaching another turning point, one he believes could affect everything from the cost of everyday goods to interest rates, housing, and financial markets. But there is an important distinction between a warning and a prediction. Some of the pressures Schiff points to are measurable. America's enormous debt load, elevated inflation, large fiscal deficits, and a bond market that has to absorb an extraordinary amount of government borrowing. Other parts of his argument are far more controversial, particularly the idea that the world is moving decisively away from the dollar and that this could force a dramatic decline in America's standard of living. So what does the evidence actually tell us? And if America's financial model is becoming harder to sustain, what happens next? Let's start with the warning.
And what I think is about to happen, and again, it's hard to say how many years, because I said this in the video I produced 5 years ago. Now, I think a lot has already happened. We're on our way. But what I think the next step is, in 1971, we went off the gold standard. But the world did not go off the dollar standard. Yes, the dollar lost a lot of value in the 1970s, so the dollar got marked down, but it wasn't counted out. The world continued to hold the dollar as if it were still backed by gold. And a lot of that was the consequence of the confidence that was restored in the 80s with Ronald Reagan and Paul Volcker. That did a lot to create confidence in the fiat dollar. And of course, we also got the Arabs to help us out with the petrodollar. We got Saudi Arabia to start pricing its oil in US dollars. And so that really helped to stabilize the dollar, because now, you couldn't get gold for your dollars, but you could use it to buy oil, and everybody needed oil.
Schiff's argument begins with a historical observation, but his real warning is about what happens when a country becomes dependent on the rest of the world to finance its consumption. The United States has been able to run persistent fiscal and external deficits while the dollar remained the world's dominant reserve currency. That does not mean the dollar is about to disappear. It means the U.S. has benefited from a very unusual position in the global financial system. And this is where the debate gets interesting. Schiff sees today's debt and trade deficits as evidence that the model is reaching its limits. Economists would put it more cautiously. Large deficits do not automatically produce a currency collapse, but they can increase the government's sensitivity to interest rates, inflation expectations, and investor demand for Treasury securities. So the real question isn't simply whether America has too much debt. It's whether the financial system can absorb that debt without forcing either inflation, higher borrowing costs, slower growth, or all three. And that's where the numbers become important.
But again, what's a lot more important to me is monetary policy and fiscal policy, because that is the driver. And in fact, later in the day, we got the Fed's balance sheet numbers, and the balance sheet expanded by $11.39 billion on the week. And that followed a $10 billion expansion in the prior week. So the Fed is doing quantitative easing. The Fed is expanding its balance sheet. That is what is inflationary. And in fact, again, looking at the national debt, continues to move up. We're almost now at $39.92 trillion. So, we've got just a little over 80 billion left to hit a $40 trillion national debt. We could easily do that in this coming week. If we don't do it this week, it's going to be next week. But it is the soaring debt and the expanding money supply that has to be what investors and what consumers are looking for as an indication of where future inflation is headed. Now, not only did we get inflation news, but we got some more economic news that also points not just to inflation, but stagflation. Retail sales, this is for July. They were expecting an increase of 0.1. Instead, retail sales plunged by 0.6. This was the biggest decline in over a year. The range of estimates was minus 0.3 to 0.5. And we came out double the low end of the estimates at minus 0.6. And again, these numbers are not adjusted for inflation. And that means that in real terms, consumer sales fell even more, or retail sales. What's happening is that prices are going up. And so consumers have to pay more for what they buy. They end up buying less because they can't afford to buy as much because the prices are higher. But retail sales doesn't measure how much you buy. It measures what you pay for the things that you buy. And the only reason that the number isn't even worse is because of inflation, because what consumers are still able to buy costs more money. So this is a negative. In fact, even if you exclude vehicles, sales were down 0.3 versus an expectation of a rise of 0.2. And if you strip out gasoline and vehicles, it was another decline, minus 0.2 versus expectations for a rise of 0.4. So way below estimates when you take out cars and gasoline. In fact, one of the most disturbing developments, I think, in the market on the week was the way the bond market reacted first to what was perceived as better than expected inflation news. And again, what really makes it better than expected is that it wasn't worse because people braced for a negative surprise, a hotter number. And so there's a sigh of relief in the markets when we don't get a hotter number. But when you couple the supposedly good inflation news, which isn't really good, but let's say it could have been worse, when you compare that with the weak economic data, especially retail sales and consumer sentiment, normally you would see a rally in the bond market. The bond market likes bad news because it means the Fed is less likely to hike rates if the economy is weaker. But instead of bonds rising, bonds fell. In fact, this was the lowest weekly close really of the year in the bond market and the highest yield for bonds. The yield on the 10-year Treasury closed the week at 4.7%.
Now we can separate the warning from the evidence. First, inflation is still above the Federal Reserve's target, but the latest data does not show an uncontrolled acceleration. July consumer prices rose 0.1% month over month, while annual CPI inflation eased to 3.4%, down from 3.5% in June. Core CPI rose 0.2% in July and was up 2.5% from a year earlier. That complicates Schiff's argument. The inflation problem is real, but the latest consumer data does not by itself prove that inflation is spiraling higher. Producer prices tell a more uncomfortable story. In July, headline PPI was unchanged for the month, but remained 4.7% higher than a year earlier. Core final demand prices, excluding food, energy, and trade services, rose 0.4% during the month and 4.7% over the year. Then there is the consumer. July retail sales fell 0.6% from June, although sales were still 5% higher than a year earlier. Importantly, the Census Bureau warns that the monthly estimate has a 90% confidence interval that includes 0, meaning the decline is not statistically distinguishable from 0 at that confidence level. Consumer sentiment is also weak. The University of Michigan's preliminary August reading fell to 51.0 from 55.2 in July, while one-year inflation expectations increased to 4.3% from 4.2%. And the labor market has softened. July payroll employment fell by 23,000 and unemployment was 4.1%. Average hourly earnings were up 3.2% from a year earlier. So the evidence is mixed. Inflation is above target. Producer prices remain elevated. Consumers are less confident. And employment has weakened. But that is not the same thing as proving an imminent monetary collapse. The stronger concern is the fiscal backdrop. CBO projects a $1.9 trillion federal deficit in fiscal 2026, with debt held by the public rising from about 101% of GDP in 2026 to 120% by 2036 under its baseline. Net interest costs are projected to exceed $1 trillion in 2026. That is the part of Schiff's argument that deserves serious attention. Because if borrowing keeps growing, the next question is unavoidable. What happens when the cost of financing the system becomes harder to ignore?
What I think is happening now, and it hasn't, it's a process, it hasn't been completed. We took the dollar off the gold standard. Now the world is going to go off the dollar standard. It should have done that in 1971, but it didn't. And because it didn't, that's what enabled the U.S. economy to grow the way it did. That's how we became a service sector economy. That's how we were able to outsource all of our manufacturing, because we were able to print the money that we needed. We didn't have to produce stuff anymore. We could just print money and use that money to buy what other people produced. See, before, when we were on the gold standard, we needed gold. We had to mine gold. We couldn't just create money out of thin air. But once we were no longer on that gold standard and there was no limit to how much we could print, we just kept printing. And we kept using that money that the world accepted to buy all of their goods. And we went for the world's biggest creditor nation to the world's biggest debtor nation. And we had this huge bubble. But $40 trillion in debt, the world's biggest debtor nation, $1 trillion a year trade deficits, the world is done. The world is de-dollarizing. The world is going off of the dollar standard. It's a process. It started. It hasn't finished. But I think the economic consequences are going to be profound. The consequences were profound when we went off the gold standard. There was a big change in the American economy. I mean, the reason that families struggle so much, the reason that you need 2 paychecks and you still can't pay the bills, this is a consequence of going off the gold standard and allowing this massive expansion of government and inflation that decimated the middle class. But we're going to be equally impacted by the world going off the dollar standard. This is going to be another leg down in our standard of living, because all of the products that we take for granted, that we can still afford despite the affordability crisis, are going to become much more expensive when the dollar tanks. And when we can't run these massive trade deficits anymore, when we can't live beyond our means, when our consumption is limited by our production, which it hasn't been for decades. But when we have to live in that world where we can only consume to the extent that we can produce, that is going to mean a dramatic decline in our standard of living. And when we can no longer borrow what the world saves, when we have to save ourselves, when our borrowing is limited by our own savings, not only are consumer prices going to be a lot higher, but interest rates are going to be a lot higher. And our economy, this phony bubble economy that we have, is based on artificially low consumer prices, artificially low interest rates, and our ability to go deeper and deeper into debt to sustain the GDP, to sustain consumption, to sustain asset bubbles, to sustain the federal government and its growth of spending. All of this is going to come collapsing down.
There are 2 different stories inside Peter Schiff's warning. The first is measurable. America is carrying an enormous amount of debt. Federal deficits remain historically large. Interest costs are rising. Inflation is still above the Federal Reserve's target, and the labor market has lost momentum. Those aren't predictions. They're current economic conditions. The second story is a forecast. Schiff believes the global monetary system is moving away from the dollar in a way that will eventually force Americans to consume less, pay more for imported goods, and face substantially higher interest rates. That outcome is possible, but it is not yet an established fact. The dollar remains deeply embedded in global finance, and a gradual reduction in dollar dependence is very different from sudden abandonment of the currency. The distinction matters because America's economic adjustment does not have to arrive as one dramatic event. It could happen gradually. Higher Treasury yields could increase government interest costs. Higher borrowing costs could make mortgages, business financing, and consumer credit more expensive. Persistent inflation could reduce the purchasing power of savings and wages. Slower growth could make the debt burden harder to manage relative to the size of the economy. And weaker demand could eventually force policymakers to choose between supporting growth and maintaining tighter financial conditions. That's why the most important thing to watch isn't one dramatic prediction. Watch the interaction between inflation, Treasury yields, federal borrowing, economic growth, and the dollar. If inflation falls while growth remains healthy and Treasury demand stays strong, Schiff's most extreme scenario becomes harder to justify. If inflation stays elevated while borrowing requirements rise and investors demand persistently higher yields, the fiscal pressure becomes much more serious. And if the dollar gradually loses international demand at the same time, the adjustment could become even more difficult. The lesson is bigger than whether Peter Schiff is right about the next crisis. A country's financial strength isn't determined by how much it can borrow. It's determined by how much confidence remains in its ability to service that borrowing without destabilizing the economy. That is the real story behind the numbers. And it is also why the next few years could matter far more than any single market prediction. If you want more economic documentaries that separate the bold claims from the actual data, subscribe to the channel. And here's the question I want to leave you with. If America's debt keeps growing faster than its ability to comfortably finance it, what do you think ultimately absorbs the adjustment? Inflation, higher interest rates, slower growth, or some combination of all three?